Hey guys, welcome to Module 2. In this module, we'll talk about some value investing principles. You don't have to be a legend to generate market-beating returns with a value investing strategy. But if you want to understand how to be a successful value investor, it will help to keep these principles in mind. Okay, the first point you need to acknowledge is that value investing is not gambling, and you should approach it with a full understanding of exactly what type of investor you are. And most importantly, you must understand exactly what you buy and why you buy it. Knowing the what and the why here is very important. You know, value investing isn't a passive strategy. Far from being a guessing game or a gamble, value investing is work. When evaluating a company, you should be able to answer the following questions and explain everything in your own words. What does the company you're investing in do? How does it make money? What are its competitors? What are the potential risks that it may take? And why do you expect its stock price to rise over time? It's important to know these things when you first invest, of course, but it's just as important to stay up to date on major developments affecting the company so that you can continue to answer those questions accurately. At a minimum, you should read the company's quarter reports and keep at least a half eye on news pertaining to the company so that you understand if its situation is changing. If something happens that lowers its intrinsic value, you'll need to reevaluate it. Do you still have a good reason to own the stock? If the company you own takes a turn for the worse, with no likely recovery on the horizon, selling its stock may be the best option, even if it means taking a loss. When it comes to investing, minimizing your risks is important, and that should be your first priority. So, that's principle number 1. Understand what you buy and why you buy it. See you in the next video. Okay, the second principle. Make sure you'll always invest in a cash-rich business. When a business is cash-rich, it means it always has abundant funds left over after paying all of its debts and expenses. It also means that its assets are liquid enough to be called upon should they be needed as an extra source of cash. So more cash simply means more liquidity. That's exactly what you'll want to look for as a value investor. And you should always make a point of investing in companies that have a strong cash position, because they're the ones most likely to pay regular dividends to their shareholders. At the same time, these companies are less likely to find themselves so strapped for cash that they are unable to service their debt loads when revenues dip or a recession hits. However, having a lot of cash is not always a good sign. You must find out if the management is utilizing their business cash well. Warren Buffett once said, "When people talk about cash being king, it's not king if it just sits there and never does anything." If the management can't utilize their business assets, it shows inefficiency in the company's operations, and that will be a red flag that you need to pay attention to. And finally, you'll want to look for cash-rich businesses with a long and uninterrupted history of dividend payments. When companies pay dividends on a consistent basis, they demonstrate stability and show a positive sign that after paying all expenses and debts, they still have a lot of cash left to pay dividends to you and other shareholders. And you know that helps increase shareholders' value, and in some way contributes to a growth in their stock's perceived value. Okay, that's principle number 2. Make sure you'll always invest in a cash-rich business. See you in the next video. Okay, besides looking for cash-rich companies, make sure you'll only invest your money in companies with a low level of debt. You're unlikely to find any well-established business that doesn't carry some level of financial liability. In fact, a little debt can be a good thing when it helps to provide the funding for business growth and expansion, since this type of activity tends to raise the overall value of a company. But that doesn't make it acceptable to invest in a business that's carrying a large debt load, since it's very easy for a company to get into trouble once it overextends itself financially and is no longer able to service or repay its loans. That is to say, having too much debt can lead to many financial troubles. So, as a value investor, you should be careful when picking a company to invest in. When looking at a company's financial statement, you'll find that there are 2 types of debt: short-term debts and long-term debts. For evaluating a company's short-term debts, you can use liquidity ratios. And for evaluating the long-term debts, you can use solvency ratios. To find out if a company's debt level is high or low, you can compare its debt ratios with that of its rivals and the industry average. And finally, you should also evaluate the company's ability to repay its short-term and long-term debts. If it can generate enough cash flow to pay its bills on time, there may not be any problem. However, if the company fails to pay its bills on time, it's going to have a problematic relationship with its suppliers and lenders, and that will affect the business in the long run. Remember that when you buy shares in any company, you are effectively lending that company your own hard-earned money. So make sure that you'll only seek out businesses with low debt loads and a reliable track record for repaying their debts. So that's principle number 3. See you in the next video. Okay, besides looking for low debt and cash-rich businesses, the next thing you'll want to consider is the quality of a company's management. In most cases, a company is only as successful as the people running it, and a big part of value investing is making sure that the business you buy into has a reliable, experienced, and forward-thinking management style behind it. One of the key factors in determining whether or not a business is on top of its game is to have a look at what gives it its competitive edge in the marketplace, and whether or not its management team has an ongoing plan in place for making the most of this competitive advantage. This means that management is not only acknowledging the competitive challenges that constantly threaten their company, but is adapting and responding to those challenges in a realistic and timely manner. To determine how well a company's management is doing in operating and expanding their business, you can use some efficiency ratios. And another great way to evaluate the quality of the management is looking at their company's competitive advantages. You need to make sure, to the best of your ability, that the people you are trusting your money with have proven themselves as effective decision makers and leaders within their industry. We'll dive deeper into how to identify a company's competitive advantages in the next module. You know, great companies should have great management teams. A great management team should focus on generating growth over time, which is the best way to reward long-term shareholders like yourself. So make sure you keep in mind principle number 4. Only look for companies that have both strong management and a sustained competitive advantages. And see you in the next video. Okay, let's talk about principle number 5. If you want to become a successful value investor, avoiding losses should be your first priority, even over generating investment gains. Remember rule number 1, never lose money. And rule number 2, never lose money. And I can tell you rule number 3 and number 4. Again, never lose money. Here's an interesting fact. It's simple math. If your portfolio's value drops by 20% and then grows by 20%, you've lost money. More to the point, in that situation, you need larger returns to meet your goals over time. That might lead you to take larger risks than you should, which could lead to more losses. As a value investor, you can minimize the risk of big losses by investing at a discount to a company's intrinsic value. And that's why you need to use the margin of safety as a part of your valuation process. While you may not always get market-beating growth, but if you can minimize losses and the need to recover from those losses, you'll need less growth to meet your investing goals over time. And besides giving yourself a high margin of safety, there are many ways you can go about minimizing losses on your investments. For example, you can easily avoid common costly mistakes like overtrading by only investing in companies that you're sure that you'll make a profit with. And before making any trade, you should always have an entry and exit strategy in mind. And don't forget to place a stop loss to protect your money. Okay, that's principle number 5. Never lose money. See you in the next video. Value investing strategies are not for those investors looking to move quickly in and out of stocks on a daily or even an annual basis. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." When you invest in value companies, you must invest for the long term, and think in terms of years or at least months, not days or weeks. In fact, Buffett believes that all short-term price movements in the stock market should be disregarded by value investors, beyond using them as an indication of the best times to potentially pick up some new holdings. You should keep in mind that long-term investments are normally those that have lower risks. Rather than watching daily stock prices, you should spend that time keeping your eye on the operational performance of the companies in your portfolio. And rather than allowing market volatility to lead you into hasty and emotional investment decisions, you should continue to base your opinions of a company's value on facts. Sometimes it can take a company a long time to see its share price rise to match its intrinsic value. If you have the time, and if you won't need the money for many years, you have a huge advantage over investors with the opposite circumstances. You can buy, perhaps at a discount, when they need to sell. Good companies can trade at valuations that seem very low for years. This can happen when investors' attention is focused elsewhere, on hot tech stocks, for example, or when a sector is out of favor. Even if it takes several years to happen, the general principle holds. The market is usually efficient over the long run, and eventually, a stock's price will reflect the company's true value. If you've bought the stock at a discount, you'll make money, or a lot of money, if you sell it once its price rises to something closer to its intrinsic value. Having the patience to wait until that happens is one key to success as a value investor. So that's principle number 6. Make sure you have a long-term investment strategy in mind. And patience is key to your investment success. Okay, the final principle that you should keep in mind: know when to sell your stocks. Almost as difficult as knowing when to buy your stocks is figuring out when it's the right time to sell them. If a company is performing well, with no indication that its future growth potential has diminished in any way, then you can hold on to their stock until its market price exceeds its intrinsic value. Or in other words, you can hold your stocks until it becomes overvalued. Sometimes, however, stocks can become overvalued for the wrong reason, and this can be a warning that a severe crisis is in the works. The most common event that leads to a movement in stock prices is when companies release news about a new product line or management change. It can be good or bad news. If it's a positive reaction, the company's stock price will rise. If it's bad, the stock price goes down. Without question, the most important factor that affects a company's value, and therefore its stock price, is its earnings. Earnings are the profit a company makes, and in the long run, no company can survive without them. If a company's earnings are better than expected, its stock price increases. But if a company's results are worse than expected, its stock price will fall. Simple as that. Another factor is market volatility. Stock market volatility often leads to stock price declines across the board, even for companies with strong business fundamentals. Market downturns could be due to several reasons: changes in the economy, profit-taking after strong rallies, and geopolitical events. However, in such circumstances, stock prices may just decline temporarily, and chances are they'll recover in a few months. So you can take advantage of these scenarios to sell your stock at a high price and then buy it back at a lower price. It's a simple strategy for guaranteed profits. Another circumstance you should consider selling your stocks before everything gets worse is when the company suddenly cuts dividends without any acceptable reasons. As a value investor, we understand the importance of dividends, so you need to be wary when dividends are suddenly cut. 90% of the time, your stock price will plunge because investors no longer feel safe about their investments, and they're so concerned about the business performance. So, that's principle number 7. Know when to sell your stocks. In the next module, I'll teach you how to identify a company's economic moats so you can easily determine if a company has sustainable competitive advantages over its industry peers. Okay, see you in the next video.
Thank you for watching. Check out the description below for more offers. Please like, comment, subscribe and share this video. Let's check out the next video in our channel.